السلام عليكم ورحمة الله وبركاته. Managerial Accounting Budgetary Planning. In this recording, we will discuss budgeted balance sheet. Budgeted balance sheet. Projection of financial position at end of budget period. This budget developed from budgeted balance sheet for preceding year plus budgets for current year. Pertinent data from the budgeted balance sheet at December 31, 2019 are as follows. Here's the correct 2019. As you see, budgeted balance sheet for preceding year. This given data from the preceding year: buildings and equipment, common stock, accumulated depreciation, retained earnings. In budgeted balance sheet, these figures will modified with the change through the current year, as we will see. Budgeted balance sheet, the first item in assets, cash. From the previous cash budget, ending cash balance 37,900, shown in cash budget. Accounts receivable 40% of the first quarter sales. As we know, the collection terms 60% in the same quarter and 40% in the next quarter. So the accounts receivable now is 40% from the first quarter sales. Finished goods inventory, result ending inventory 1,000 units, shown in the production budget, times total unit cost 44. Raw materials inventory, result ending inventory from budget. Raw materials was 1,020 pounds times the cost per pound $4, shown in direct materials budget. Buildings and equipment, December 31, 2019 balance given plus the addition through the year purchase of a truck for $10,000. The new balance for building and equipment, the balance from December 31, 182,000 plus the addition for fixed assets $10,000. Accumulated depreciation will be the balance at December 31, 2019 plus the depreciation for the current year 15,200 depreciation shown in manufacturing overhead budget plus $4,000 depreciation shown in selling and administrative expense budget. Accounts payable, 50% of the first quarter purchases 37,200, shown in schedule of expected payments for direct materials. Common stock unchanged from the beginning of the year. The current year there wasn't any issuing for shares, so the common stock, the balance the same. Retained earnings December 31, 2019 balance, beginning balance for the current year plus net income 47,900 shown in budgeted income statement. Here's the list of the budgeted balance sheet as you see: current assets, cash, accounts receivable, finished goods inventory, raw materials inventory, total current assets, property, plant and equipment, building and equipment, less accumulated depreciation, total assets. Liabilities and stockholders' equity, liabilities, accounts payable, stockholders' equity, common stock, retained earnings, total stockholders' equity, total liabilities, and stockholders' equity. Now we will discuss budgeting in non-manufacturing companies. In manufacturing companies, we say 10 budgets. But now if we in merchandise, we will use, instead of manufacturing budget, the purchase budget. And we do not need manufacturing budgets as direct materials, direct labor, manufacturing overhead. Now we will see how to budgeting in merchandise for merchandise companies. Sales budget, starting point and key factor. Number 1, sales budget. Second, use a purchase budget instead of a production budget. In merchandise company, we use a purchases budget instead of a production budget. Doesn't use manufacturing budgets, direct materials, direct labor, manufacturing overhead. So in merchandise company, instead of a production budget, we prepare purchases budget. And these 3 budgets is not used. Budgeted cost of goods sold plus result ending merchandise inventory less beginning merchandise inventory equal required merchandise purchases. Purchase budget is this equation: budgeted cost of goods sold plus result ending merchandise inventory less beginning merchandise inventory equal required merchandise purchases. Exercise: Remax expense budget sales will be 300,000 in July and 320,000 in August. Cost of goods sold is expected to be 70% of sales. You must deduct the ending inventory is 30% of the following month's cost of goods sold. Required merchandise purchased for July and computed for July are computed as follows. This cost of goods sold. Budgeted cost of goods sold for July, it's 70% from sales. Sales 300,000 times 70%. These are ending merchandise. These are ending merchandise inventory from the cost of goods sold, 30% of the cost of the next month. Without ending inventory is 30% of the following month. Cost of goods sold. So without ending in merchandise inventory, the cost of goods sold in August will be 320,000 times 70% equal to 124,000 times 30%. As you see, ending inventory is 30% of the following month's cost of goods sold. Next month's sales 320,000 times the cost 70%. Here's the cost of goods sold in the next month. The result will be 30%. Less beginning inventory. Beginning inventory هيكون عندي الكوست of goods sold times 30%. Required merchandise purchased for July 214,200. 214,200. Now the budgeting in service companies. In service companies, critical factor in budgeting is coordinating professional staff needs with anticipated services. In service companies, as you see, maybe the organization is manufacturer or merchandise or service. In service companies, the budgeting, the point is to coordinate professional staff needs with anticipated services. If the professional staff overstated, we meet these problems. If we have a lot of staff, we meet these problems: high labor cost, lower profit due to additional salaries, staff turnover due to lack of challenging work. Here's the problems if we have a lot of staff, overstaffed. On the other side, problems if understaffed. If the professional staff is understated, lost revenues because existing and future claims need for service cannot be met. Lost revenues because existing and the future client needs for service cannot be met. Other problem, loss of professional staff due to excessive workloads. When the professional staff is understaffed, the current staff maybe leave the work because excessive workloads. Exercise Stephen Lewan and Blowing Surface estimates that it will serve 300 small Lewans, 200 medium Lewans, and 100 large Lewans. During the month of July, It estimates its direct labor needs as $1 1 hour per small Yuan, 1.75 hours for a medium Yuan, and 2.75 hours for a large Yuan. Its average cost for direct labor is $15 per hour. Siemens prepares a direct labor budget as shown. For months ending July 31, 2020, for small, for medium, for large, total. He wants to be served number 300, 200, 100. Direct labor hours per Yuan, as we see. Total required direct labor hours times rate for hour. Direct labor cost per hour $15. Total direct labor cost total $13,875. If we want to make budget for not for a profit organization, just as important as for profit-oriented company, the budget is very important for not for a profit organization NGOs as the profit-oriented companies. Budget process differs from profit-oriented company. The budget differs on these things. Budgets on basis of cash flows. Budget on not-for-profit organization basis of cash flow, expenditures and receipts, not on revenue and expenses basis. Budgets process differs from profit-oriented companies. 1. Budget on basis of cash flows, expenditures and receipts. Cash outflow and cash inflow, not on revenue and expense basis. Expenditure, cash outflow, and receipts, cash inflow. Not on revenue and expense basis. Starting point is usually expenditures, not receipts. We begin the budget with expenditures, not receipts. Management task is to find a receipt needed to support planned expenditures. Here's the crucial task, the important task for management: to find cash inflow, to find grants, to find receipts needed to support planned expenditures. Budget must be followed. Overspending often illegal. The budget for a merchandise differs from a budget for manufacturing because a merchandise purchases budget replaces the production budget. The manufacturing budgets are not applicable. None of the above, both A and B above. The correct answer A, D. Another example for merchandise purchase budget: do it. B company estimates that 2020 sales will be 15,000 in quarter 1, $20,000 in quarter 2, and 25,000 in quarter 3. Cost of goods sold is 80% of sales. Management desires to have ending finished goods inventory equal to 15% of next quarter's expected cost of goods sold. Prepare a merchandise purchase budget for a quarter for the first 6 months of 2020. Budgeted cost of goods sold in first quarter will be 80% from sales. Sales 15,000 times 80%, 12,000. We add desired ending merchandise inventory, which is 15% of next quarter cost of goods sold. As you see, ending inventory will be 15,000 desired ending merchandise inventory 15,000 of next quarter's cost of goods sold. Cost of goods sold for next quarter 16,000, which is 20,000 times 80%. Now the desired ending inventory 15 of next quarter cost of goods sold, وبالتالي %15. Finished goods ending. Finished goods inventory ending merchandise inventory equal 15% of the next quarter expected cost of sales. Less beginning merchandise inventory 15% this quarter cost of sold 18,000, which is 12,000 times 15%. Required merchandise purchase for the 6 months 29,200. Required merchandise purchases for the first 6 months is 29,200. Thank you.